Another stock that came on my radar last night and which I rejected was REC. So let me bring up that chart for you. Why do I keep creating these videos where I show you the stocks that I'm rejecting? Well, this is very important because, as I have said many times before, your trading performance is more a function of how many stocks you reject compared to how many stocks you select. Your ability to reject stocks is more important than your ability to select stocks. My goal when I am looking at stocks is to keep rejecting them for one reason or another until I reach a stock where I just don't find a reason for to reject the stock. When I find that kind of a stock which is very compelling, okay, that is the stock I put my money in. Okay. It is very important because the market will keep throwing opportunities at us. Now we have to figure out whether it's an opportunity or it's a trap. So that is the reason why I keep creating videos to show you what are the stocks that the market is throwing at me, okay, on my radar screen based on my filters, and why I am saying continuously no to these stocks, okay, for one reason or the other. Yesterday, I made a video where I discussed ITD cementation. The reason why I rejected the stock is because the industry to which it belonged, which is building heavy construction industry, that industry performance was declining. Everything about the stock was great. But if the industry performance is declining, I know that 50% of the performance of the stock depends on the performance of the industry. So if the industry performance has been declining, why should I put my money in the stock? Okay, that is one. Let's come back to this stock, REC. Okay, this belongs to financial services industry specialty. So number one, I look at the moving averages. So the 50-day simple moving average is above the 150-day, and the 150-day is above the 200-day, and the price is above the 50-day. So this is a strong uptrending stage 2 stock, which is a good sign. Now, as you hear what I am discussing, try to see how many positive factors are there in the stock and how many negative factors are there. You will realize that whenever I am rejecting a stock, it is either because the negative factors outweigh the positive factors, or the negative and positive factors are same, but there is some other factor which is weighing on the stock, which is why I am rejecting the stock. Okay. So one positive factor is it is in an uptrend. Next, I need minimum 10 candles in the base. So the base starts from here. So if I start counting from here, I get minimum 10 candles in the base, which is minimum 2 weeks of consolidation. That's another positive factor. Number three, I look for consolidations in the base. So if I draw this base for you, this is point 1, this is point 2, that's point 3, 4, and 5. This is the latest candle. This is today's candle. As you can see, the market is open. It is 10 o'clock in the morning. So I'm not considering this candle. So you have 5 points in the base. We need minimum 4 points. So that's another positive sign. Okay. So all the factors are positive till now. One negative sign I see here is there is a falling window inside the base, which is closed, by the way, by this candle. But I don't like to see falling windows inside a base. A falling window is an extremely bearish sign. And if at all there is a falling window, I want that window to be closed with high volume, okay, which in this case has happened, which is a good sign. Okay. Another positive that I see for this stock is the buy point is coming in the first quarter of the base. The green zone is the first quarter of the base. The blue zone is the second quarter of the base. The buy point is coming in the first quarter. That's a positive sign. Another positive sign is there is tight price action towards the right hand side of the base. We don't want volatility. We want tight price action, okay, which you see here. We don't want this kind of volatility towards the right side. We want tight price action, tight closing. So till now, you see a lot of positive factors. Okay. So you might be wondering, if everything looks good about this stock, then why is Rohit rejecting this stock? Okay. What's the problem with this stock? Well, let us look at some other factors. Let us go to Market Smith. Let us see where the stock stands compared to the overall market, because this is not the only stock in the industry. In the stock market, there are 5,000 other stocks. We need to compare this stock with those stocks, right? So let's go there. Let's type here REC. So when this page opens up, I click here. Okay. Yeah. So this is the data. So if you see here, if I click here, it says stage one pattern double bottom. So it's forming a double bottom, which is another positive sign. Another positive sign is base one. So I'm buying the stock. If I buy the stock, I will end up buying it in base one, which is earliest of the early stage. Remember what I told you in base counting tutorial? When a stock goes from base 1 and 2 to base 4 and 5, it has already given a triple digit return. Now, triple digit does not mean 100%. It could also mean 200%, 300%, sometimes 500%. Look at stocks like Nvidia, look at stocks like HBL Power Systems, look at stocks like Anantraj, or look at stocks like Choice International. You will find that by the time a stock goes from base 1 and 2 to base 4 and 5, it has already delivered multi-bagger returns. Okay. And here I am getting a stock which is in base 1. Okay. Base 1. That too a clearly identified double bottom base by Market Smith. What else do we want? Okay. That's couple of more positive points. So see, as you can see, the positive points are piling up. Okay, I might, while making this video, I might make myself talk into buying the stock. Okay, I might buy the stock today, but no, that is not the case. I have rejected the stock already. It is not in my watch list for today. But let's look at the other factors. Relative strength line is flat, which is okay. Now, this is one negative factor. I want the relative strength line to be rising, because a relative strength line compares the performance of the stock with the Nifty 50 index. So I want it to be rising. See, in the base, the volume is contracting. Another positive sign. Price contraction, volume contraction. So all the factors that a winner needs, it's here in this stock. Let's come to the fundamentals. Now, here is the problem. Okay. If you look at the fundamentals, I want this quarterly growth to be minimum 40%. I learned this from Patrick Walker. If not 40, at least 25%, and increasing or accelerating earnings growth. So the fundamentals of the company don't meet the criteria laid down by Patrick Walker, who is a veteran trader in the US market, nor does it meet the fundamental criteria laid down by William O'Neill. William O'Neill wants accelerating sales growth, accelerating earnings growth, latest quarter sales and earnings growth to be minimum 20 to 25%. That is not the case here. So even if you buy the stock, this is not something that we hold for long term. This is not a positional trade. This would at the max be a swing trade, which means the holding period could be 2 to 3 weeks maximum 1 month. If we get a double digit return in 1 or 2 months from this stock, that would be considered fantastic. So you see a negative factor here. Another negative factor is the buyer demand, the institutional demand is B. I want it to be A. Another negative factor is master score 69. I want this to be minimum 80. Okay. Another negative factor is group rank 47. I want this number to be less than 40 or preferably less than 20. So the industry is not performing well. Overall, considering technical and fundamental factors, the master score is not that great. Institutional demand is not at its peak. Okay. Institutions are probably just coming into the stock. Return on equity is fine. Okay. The PE ratio is in the higher end of the 5-year PE range, which is good. But the PE itself, the standalone PE number itself is not that great. For a growth stock, the PE cannot be 11. It has to be far more than 11, at least 20, 30, 40. And it should be towards the higher end of the PE range. This is the characteristic of growth stocks. You will find them at expensive PE. This is a cheap stock. Okay. And it's a very large company, by the way. That's a negative factor. If you have a very large cap company, now for this stock to double, okay, this has to double. That's a very large number, by the way. Okay. So that's another negative. So as you can see, now the negative factors have started piling up. Till now, till now in the video, we were all talking about positive factors when we looked at technicals. But when we compare this stock with other stocks in the stock market, now we see some weakness. Okay, so now it's like the negative factors and positive factors are coming together. So the negative factors are like neutralizing the positive factors. So this is how you take a judgment call. You just don't use rules. If you are using rules, you will not be flexible enough to do a proper assessment of a stock. I want you to become flexible. I want you to look at the overall picture. Okay. If one or two factors are off, you can still take the trade. But if all the negative factors are you know more or less equal to all the positive factor, then there is a problem. We want the positive factors to be, we want the skew to be towards positive factor. There should be more positives than negatives for you to really take a meaningful position in the stock. Here, if you see positive and negative factors, they neutralize each other. Moreover, very important point, one which I discussed yesterday, is that the industry rank. Let's go to that. The industry is financial services specialty. Let's go to that industry. I want to see how the industry is doing. See, if I'm buying a stock which is not in the top 40 industry groups, okay, at least I need to see whether the industry rank is improving. Okay, so let's go to the industry. So I go to markets, I click on 197 industry groups. So I go to click here, okay, it sorts by ascending, sorry, the A to Z, okay. So let's go to financial services specialty. So financial services specialty. So see this. You see the industry rank. 6 months ago, the rank was 45. 3 months ago, it was 75. What does that mean? The industry rank has worsened. Okay, higher the rank, poor is the performance of the industry. So from 45, it went to 75. That means that's a big decline. Okay. Then again, it came down to 40, which means the industry rank improved by last week. Okay. But then again, it went to 47, which means the industry rank has gone from 40 to 47 in 1 week, which means the overall industry performance is declining. Okay. At least in the past 1 week. If we look at 3 months, it's not declining, but at least in the past 1 week, you see a meaningful decline. There are 7 industries which have gone beyond this particular industry. And if the number of stocks were low, we can understand, but this is 141 stocks, which means overall, there are a lot of stocks that are pulling the industry down. It's not just one or two stocks that are influencing the industry. There's a lot of stocks in the industry which might be pulling the industry down. And William O'Neill has already said that 50% of the performance of a stock, 50% of the price movement of the stock is attributable to the performance of the industry. This is a very important point. So if the industry is not doing well, probably the stock is not likely to do well. Just like if the general market or the indexes are not doing well, then 3 out of 4 stocks are going to follow the market. They are not going to do well. Only 1 out of 4 stocks is likely to outperform when the market itself is in a weakness. So imagine if the market tomorrow goes in a weakness, the industry strength is declining. No matter what happens in the stock, no matter how positive the stock looks from a technical fundamental point of view, the weakness of the market and the weakness of the industry will weigh in on the stock. So I will give it a pass. Okay, why would I put my money in a stock which comes from an industry group which itself is declining? Okay, there are 5,000 stocks in the stock market. I can wait. Okay, so this is my justification. This is my reason for not putting money into the stock. Now, this is extremely important. Whatever I am discussing, you must have noticed. I am looking at fundamentals. I am looking at technicals. I am looking at the base. I am looking at the industry performance. I am comparing the stock with all other stocks in the stock market. I am looking at earnings, sales, earnings per share, return on equity, the price performance of the stock, the relative strength line. I mean, what else? What else is left? This is all you have to see. Even the champions, they look at the same factor. These are the primary factors that affect the performance of the stock, that affect the price performance of the stock. If you are not looking at this, then you are not a professional trader. You have to look at all of the factors and then you have to take a call. Is this a swing trading opportunity or is this a positional trading opportunity? Once you finalize that, then accordingly you can take a holistic view on the stock and decide whether you want to pull the trigger. And if you really feel compelled to put money in the stock, go in with a small position size. Who said that you have to put 5%, 10% into the stock? You could go in with a 2.5% position size just to probe the stock, right? If it starts to make money, fine. If it will add to your portfolio performance, but if it loses money, you won't lose much because you control your risk by controlling your position size. And by the way, any stock you buy, an 8% stop loss is always recommended. That is for capital preservation. So money management and risk management is an entirely different subject. It has got nothing to do with stocks and industries and the market. That's a separate issue altogether. We have to combine all of this and then take a call. So, as you can see, this is where trading starts to become an art rather than a science. To a certain extent, you can apply science, you can apply mechanical rules. But as your expertise begins to grow, sometimes one or two factors might be off, but you might still end up buying the stock because the industry strength itself has been improving since the past 6 months. Okay, that is where the art comes in. So trading is science as well as art. As your expertise improves, it becomes more of an art than a science. Okay, so I hope you understood and you liked the video. Please don't forget to like, comment, and share this video so that it reaches like-minded people like you who are interested in becoming professional stock traders. Thank you so much.